Welcome back to Wespath's Quarterly Review. All of us at Wespath hope you had a wonderful and rejuvenating holiday season. I'm Frank Holsteen, Managing Director of Wespath's Investment Management Team. My team oversees the management of Wespath's investment funds. As it's the beginning of a new year, this video will be more robust than previous quarterly reviews. Over the next several minutes, I'll recap the major investment news from the fourth quarter of 2022, review themes from the entire year, and share some of what investors will be looking at in 2023. Let's start with the fourth quarter. This period was fairly positive for financial markets, which was a breath of fresh air following a challenging year overall. One reason for this year-end optimism was an improvement in the inflation picture. U.S. inflation was lower than expected in both November and December, causing some investors to think the Federal Reserve will slow the pace of its interest rate hikes sooner than previously anticipated. Investors are closely watching what the Fed is doing with interest rates, and markets have had strong reactions to Fed action. During the past year, the Fed consistently raised interest rates. This was intended to temper inflation by increasing the cost of borrowing money. When borrowing gets more expensive, demand for goods and services generally goes down, which can help cool off an overheated economy. The concern is that the Fed will do too much to cool the economy and unintentionally trigger a recession. Better than expected inflation reports in the fourth quarter raised hopes for a soft landing, a scenario where inflation goes down without a recession. Despite this optimism, it will take more time to determine where exactly inflation is going and what the Fed will do about it. It's also important to note that some signs of positivity in the fourth quarter did not outweigh the overall negativity of last year. Both stock and bond markets were negative in 2022. In the U.S., the S&P 500 index of stocks declined about 18%, while the Bloomberg U.S. Aggregate Bond Index fell 13% for the year. For comparison, the S&P 500's average annual return is around 10%. Likewise, a double-digit percentage decline in the bond market is exceedingly rare. This type of simultaneous decline is also rare in itself. Stocks and bonds tend to be negatively correlated, meaning they move in opposite directions. Historically, investors might expect a bad stretch for stocks to be a good stretch for bonds and vice versa. You may have heard of the 60-40 portfolio concept, which describes an investment portfolio with 60% stocks and 40% bonds. Such an approach has been popular because of this negative correlation, as it balances out some of the highs and lows of each market. But the opposite was true in 2022. The correlation between stocks and bonds became positive, and 60-40 portfolios suffered. In fact, this type of portfolio tallied its worst year since 1937. Another sign that 2022 was an historic year for investors, and not in a good way. As we've shared before, the primary driver of this excess volatility was inflation. Many thought inflation would be transitory, a temporary price spike caused by trying to rejuvenate economies that had been shuttered by COVID lockdowns. In 2022, markets quickly realized that inflation was going to remain stickier for much longer. Other global news throughout the year added concerns for investors by contributing to inflation and creating other economic uncertainties. Notably, the Russian invasion of Ukraine led to volatility in food and energy prices. Meanwhile, mounting tensions in and around China underscored supply chain disruptions and concerns about economic growth. Now we begin looking ahead to what 2023 has in store for us. It is, of course, difficult to predict what markets will do this year, but we can say with confidence that many of the catalysts for market activity will remain the same. Inflation and central bank policies will continue to dominate headlines. Investors will wait to see whether inflation will return to a more typical range of 2 to 3%. And perhaps more importantly, they will look to see if policies enacted to temper inflation result in a hard landing, thus causing an economic recession. You're likely to hear that word, recession, quite a bit this year. In fact, many would argue that a recession has already begun. It could also be that an overall economic recession isn't the most important question. For example, you may hear investors talk about an earnings recession. This term describes a decline in profits or earnings generated by companies. Right now, a consensus of analyst estimates for companies in the S&P 500 indicate modest growth this year, but any weakness in earnings reports going forward could be a sign of trouble for markets. On a positive note, the job market continues to show strength, with wages moving higher and unemployment remaining relatively low. We also anticipate that 2023 will mark another year of exciting technological advancements, from artificial intelligence and robotics to advances in medicine and clean energy. There's plenty on the forefront for investors to be excited about. This is yet another reminder that investors have a lot of data points to consider. Inflation, GDP, earnings, jobs, technology, even conflicts in other countries and disruptions to supply chains. All of these things are relevant to the health of the economy and how markets perform. All these factors tend to ebb and flow, and predicting them is challenging. As always, we remind you to stay the course, remain prudent in your investments, and focus on long-term results.